Hi everyone, welcome to our webinar today. The topic for today's webinar is evaluating the financial performance of Connecticut's low and moderate income solar lease program. This webinar is being presented by the Clean Energy States Alliance, and we have with us a number of excellent panelists from the Lawrence Berkeley National Laboratory. Before I pass it over to them for our presentation, I'd like to go over a few quick webinar logistics. All of our attendees for this webinar are in listen-only mode. You have a couple of options to join the audio portion of our webinar. You can call in via telephone, or you can connect using your computer, mic, and speakers. If you'd like to minimize your webinar console so that you can view the presentation full screen, you can click on the orange arrow that you see circled there on your webinar control panel. And you can also click on that arrow to expand the webinar console. And one of the things that you might like to do with your webinar console is to submit your questions or your comments. We'll be saving about 15 minutes at the end of the webinar presentation for a Q&A with the audience, and we'll get to as many questions as we can. So please do type those questions in when you think of them. We'll get to as many as we can. A final note, this webinar is being recorded. We will send you an email this afternoon with a copy of the webinar recording and a PDF of the webinar slides, and we'll also be posting all of those webinar materials on CESA's website at cesa.org/webinars. So with that, I'd like to now pass it over to our moderator for today's webinar, Nate Hausman. Nate is a project director here at the Clean Energy States Alliance, and he's going to get us started.
Great, thank you, Samantha, and welcome everyone. Nate Hausman here. I am indeed a project director at the Clean Energy States Alliance. I focus on solar policy. And first, just a quick note about the Clean Energy States Alliance, or CESA. We are a national nonprofit coalition of state energy organizations working together to advance the rapid expansion of clean energy technologies and to bring the benefits of clean energy to all. So you can see the logos of our members on this slide. This webinar is being conducted under CESA's Scaling Up Solar for Under-Resourced Communities project. It's a U.S. Department of Energy supported multi-year project. We're working to accelerate the development of solar projects for 3 distinct subsets of the low and moderate income solar market: single-family owner-occupied homes, manufactured homes, and multifamily affordable housing. And under each of these market sectors, we're undertaking research, outreach, and various market building activities. Next. Today's webinar focuses on our work on the single-family home sector of the project. For the single-family homes market sector, CESA is working with project partners to evaluate and adapt a solar leasing program for low and moderate income homeowners that's been piloted in Connecticut. You're going to hear more about how Connecticut's program works shortly, so I'll save those details for now. But suffice it to say that CESA, in collaboration with our project team, the Connecticut Green Bank, Inclusive Prosperity Capital, and PosiGen, we formed a working group for state officials to learn more about Connecticut's program and to explore launching a publicly supported solar program for low and moderate income homeowners in their states. We've also established a learning network to share information and analysis on Connecticut's program with interested stakeholders, and you can join our learning network if you're interested in receiving more of these materials at the URL on this slide. Lawrence Berkeley National Lab has analyzed Connecticut's program to evaluate its financial performance, and that's the focus of today's webinar. That's what Berkeley Lab's going to present today. So this webinar is titled Evaluating the Financial Performance of Connecticut's LMI Solar Lease Program. I'm going to introduce all 3 presenters from Berkeley Lab now: Greg Leventis, Sean Murphy, and Jeff Deason, and then I'm going to turn it over to them. So Greg Leventis is a program manager in the Electricity Markets and Policy Department at Lawrence Berkeley National Lab. Greg conducts research and analysis of demand-side efficiency and coordinates technical assistance for the Department of Energy's National Community Solar Partnership. Greg holds a Master's of Public Policy from the Goldman School of Public Policy at the University of California, Berkeley, a BA in Economics from the University of Florida, and studied the general course at the London School of Economics. Sean Murphy is a scientific engineering associate in the Electricity Markets and Policy Department at Berkeley Lab. Sean's research focuses on utility administered energy efficiency programs and property assessed clean energy financing. Sean holds a BS in environmental engineering from the Johns Hopkins University and is currently pursuing a master's of public policy from the Goldman School of Public Policy at the University of California, Berkeley. And last is Jeff Deason. Jeff is a program manager and energy efficiency team lead in the Electricity Markets and Policy Department at Berkeley Lab. Jeff studies a number of energy efficiency and distributed energy resource topics with a focus on financing programs, building electrification, and energy efficiency in housing markets. He has a master's degree in public policy from UC Berkeley and BS and MS degrees from Stanford University. Okay, with that, I'm going to pass it over to you, Greg. Take it away.
Okay, thank you, Nate. I appreciate that. Thanks also to Sam and everyone at Clean Energy States Alliance. I also want to thank the Solar Energy Technologies Office at Department of Energy for funding this work and for providing data and answering lots of questions about their programs, thanks to PosiGen and the Connecticut Green Bank, which I'm gonna, and Inclusive Prosperity Capital. I'm gonna refer to Connecticut Green Bank as CGB in the presentation. Now, the motivation for this project is to inform other efforts where folks want to develop broadly similar programs to the one that we focus on in this study, but the circumstances and contexts will differ. And so that's important to keep in mind while we are presenting our findings here. Let's see if I've gotten my, okay, great. So I'm gonna first give you an overview of the project, which is gonna include describing the Connecticut Green Bank or CGB, PosiGen, our research questions, our data and methodology, and then I'll describe the population served by the PosiGen program and how that compares to other CGB programs. After that, I'll turn it over to my colleague, Sean Murphy, who will discuss repayment performance of the CGB PosiGen program, both individually and in the context of other CGB programs. Then my colleague, Jeff Deason, is going to go over comparison of the CGB PosiGen performance to external benchmarks. And then finally, Jeff is going to wrap up with an overall perspective on the PosiGen program. So I do want to point out that the slide deck is available on Berkeley Lab's website. And as Sam mentioned, CESA will be sending out a recording of the webinar as well as the slides from the presentation. So starting with a description of the players involved, Connecticut Green Bank is a quasi-public financial institution dedicated to increasing clean energy in Connecticut, and PosiGen is a private company with the goal of helping low and moderate income households access clean energy. What I want you to take away from this slide, though, is that CGB and PosiGen are mission-driven entities, one private, one quasi-public, that have made significant investments in clean energy through public-private partnerships. Now looking specifically at the program, so this program is one that CGB and PosiGen offer together. In 2015, CGB and PosiGen began the partnership, offering the package that we analyzed in this study. It's a 20-year lease for single-family homeowners to get a solar PV system and some selected energy efficiency improvements. There's no down payment, no escalator, and the deal is structured so that the participants should see immediate energy cost savings. And in fact, PosiGen guarantees that participants will see energy savings in the first year. And if that guarantee isn't met, then PosiGen is responsible for making the customer whole. And the PosiGen underwriting does not include standard metrics like credit score and debt to income ratio, which makes it more accessible. Now, CGB facilitates lower pricing for customers in the program by providing below market rate debt to PosiGen and by providing a production-based incentive, which is higher for low and moderate income customers. So this is a conceptual model to illustrate at a high level the relationship among stakeholders in the CGB PosiGen program. The details of the financial arrangements are certainly more complicated than this, but it gives you an idea of how the money flows in the program. So starting at the bottom here is a participating customer who receives a PV system and efficiency upgrades and makes lease payments to the holding company right above them. And the holding company is a legal entity that owns the PV systems. The shares of the holding company are owned by the tax equity investor that you see to the right here to monetize the tax credit. And then the managing member of the holding company is PosiGen, which is up to the left. So PosiGen, which is a private program partner in the Connecticut context, receives returns from the holding company and funds the holding company through debt and equity. And PosiGen receives debt funding from private external investors whose debt is senior, you see them to the top right, and from CGB, which is the public program partner in the Connecticut context, and their debt is subordinated. You see them to the right in the middle there. So in addition to providing debt funding to PosiGen, CGB provides the production-based solar incentive to the holding company as well. You see the little arrow here. So in this model, PosiGen bears most of the risk for the customers not taking their lease, not making their lease payments. They're also on the hook for the guarantee if sufficient savings don't materialize, but CGB is not exposed to the risk of participating customers not paying. But if PosiGen as a company were to be unable to make debt payments, then CGB would be exposed to loss. So the external investors are at low risk because of the subordination, but in a different structure, the level of risk could be different. And that's also true for the tax equity investor. They likely bear little risk, but we're not privy to the details, so we can't be certain about that particularly. And then finally, the risk for the customer includes the consequences of non-payment, although the savings guarantee is an important risk mitigation there. So these are some specifics about the model I just described. These are also some specifics about the risk in the model I just described. And that brings us to our research questions. We have three. The first is the program reaching the low and moderate income customers that are its target audience? Second is, how are the leases performing? And then the final is, how does this performance compare to the other CGB products that finance residential solar PV? And how does it compare to other similar forms of consumer debt, particularly securitizations of private solar loans and leases, but also auto loans and consumer loans? And I'll note here that we don't have sufficient information to assess how program terms like monthly payment levels affect LMI participation and performance, and how much those terms depend on the level of public partner support. So the way we approached the research questions was through customer level data on the CGB PosiGen program and on 3 other CGB financing programs. Note, all of the data are from March of 2020. And we broke down the data in a number of ways: by credit score, income, principal amount, system size, loan vintage, which is what year the loan was originated, and loan seasoning, which is how long the loan has been, how long it's been since the loan was originated. So now to take a more detailed look at the population served here. First off, this first slide is on the program participation by income. And this is based on what census tract the participant lives in. So on the bottom here, we have bins for the area median income, or AMI, going from below 60% to over 120%. And on the left, we have the percent of leases that fall into each bin. And as you can see here, the program has significant participation from LMI households. And in fact, by census tract anyway, over 3/4 of the participants could be considered low or moderate income. And then looking by credit score, as we'll show in a moment, PosiGen doesn't use credit scores to qualify applicants for their leases, but they have collected credit information for the participants. And here on the bottom, we have the FICO score bin, and on the left again, we have the percent of leases that fall into each bin. And you can see that most participants' credit scores are below 670, which is generally considered non-prime. So not only is the participant pool largely low and moderate income, there are also folks who might have difficulty accessing financing through traditional channels. Now this slide simply gives you an idea of what average projects look like. I'm not going to go through this, but if you're interested, again, the slides are available on the Berkeley Lab website and will be sent later on. Next, we're going to compare the CGB PosiGen participant pool with the participant pools of other CGB programs. It is worth emphasizing that none of these other programs has a primary focus of attracting low and moderate income customers. The three programs are, first, the Smarty Loan. This is a program that is currently active. It's a loan and it finances both solar and efficiency. But for this analysis, we only included projects that were solar. And then there is the Solar Loan Program and the Connecticut Solar Lease Program. And these two programs are no longer offered. And then quickly, just from a customer perspective, did want to point out that participating in the PosiGen program costs a little under $13 per kilowatt, which is closer to the solar lease program and cheaper than the solar loan programs. But then comparing the participant pools by area median income, we see on the left here that the percent of lower income participants in PosiGen's pool is really significantly higher than for the other programs. And here we see the same thing for credit. A much higher percentage of the participant pool for PosiGen program is comprised of lower credit participants. Now, this is also true when you compare PosiGen participant credit scores to general US credit scores, as you can see here. One caveat is that these are not necessarily borrowers. This is all US folks who have been rated in the US. So just quickly, PosiGen system sizes are pretty standardized. They're between, mostly as you can see, between 5 and 10 kilowatts. And because of that standardized system size, we also see that the amount of principal for the PosiGen leases is also pretty concentrated, between $15,000 and $25,000. Now here, this shows the eligibility criteria for the 4 programs, and the takeaway is that the other programs use standard underwriting, but PosiGen's underwriting is more flexible and doesn't include some of those metrics, which can make the PosiGen packages more accessible to lower income folks and more specifically lower credit folks. And we see that here, the PosiGen customers, a large share of them would not qualify for other CGB programs. Again, these other programs aren't specifically focused on LMI, but the Smarties has both a standard and credit challenge term sheet. Under the standard term sheet, 44% of the PosiGen customers wouldn't have qualified, and 25% wouldn't have qualified under the credit challenge sheet. The same is true for the solar lease program or the solar loan program. Now, some of the PosiGen applicants probably wouldn't have qualified for these for other reasons as well, but this shows how important the underwriting criteria can be for reaching LMI and credit challenge households. So the takeaways from these participant characteristics are, one, that the CGB PosiGen program has been successful in reaching more underserved customer base as compared to the other CGB programs. Two, it's likely that many PosiGen customers wouldn't have been able to qualify for other programs, so the solar projects on their homes would not otherwise have been possible. And three, the differences we see in participant characteristics particularly credit scores, means that we should expect to see differences in repayment performance. So now I'm going to turn it over to my colleague, Sean Murphy, to talk about that performance.
All right, thanks, Greg. So now we're going to talk a little bit about the repayment performance of PosiGen and the other CGB solar financing products. Let's see, once I get the control there. Great. So the goal here is to document the financial performance of PosiGen leases in Connecticut and compare them to the performance of the other CGB solar financing products. In this analysis, we had a snapshot of loan level data to understand the driver's performance that we're going to get into. So first I want to start off with some definitions, just so it's clear what we're talking about and what it means in terms of performance. The first is delinquency, which we define as any lease or loan with payments that are 30 days or more late and is neither terminated nor paid in full. Next, we're going to be talking about early termination, which refers to leases or loans that lenders have declared unrecoverable. We're not applying a definition of unrecoverable here, just following each lender's own definition and the data that they report. We also distinguish early determination from charge-off because of the potential redeployments that can occur in PosiGen, which we'll talk about a little bit later. And charge-off in some contexts can also mean that a balance is unrecoverable. Next, there's the cumulative gross loss rate, which is the share of the total principal that was terminated as of March 31st, 2020. As I mentioned, we're working sort of with a snapshot of loan performance. So all of the losses and delinquency they're talking about is as of that date. And finally, the last metric that we use is the annualized gross loss, which is the cumulative loss divided by the average years of seasoning. Years of seasoning is how long a loan has been around. So this removes the impact of the different age portfolios and allows us to kind of normalize losses across different portfolios. So here we're going to take a look at delinquency and annualized gross loss by program. So here we're showing both the delinquency and annualized gross loss. The delinquency is in the columns and the dots indicate the annualized gross loss. The delinquency is indexed to the left-hand axis, goes up to 3%, and the annualized losses are indexed to the right-hand axis, just so you can get a sense of which numbers each of these bars relate to. We also take a look at two ways of measuring delinquency. One of which is based on the count of loans, and the other is by the dollar amount of the loans. Both are in line with each other, which suggests that the delinquency is not varying much with loan size. And we also calculate this loan-based delinquency so that we can estimate a confidence interval, which is indicated by the black bars extending from the two delinquency values. And given that the sample size is relatively large and the confidence intervals are not overlapping, we can feel confident that the differences between the delinquency rates with PosiGen and the other CGB products is not due to chance. And what we're finding, at least in this figure, is just overall there's slightly higher delinquency rates in the PosiGen program. We're going to get into the factors that explain those differences because they're important differences in the characteristics of the programs, as Greg just summarized, that can help explain the differences that we're observing in this figure. So first, we're going to take a look at how the repayment performance varies by credit score. So here we're taking a look at, again, the 30-day delinquency and the annualized gross loss. And just what stands out is that there's a pretty strong relationship between credit score and both forms of performance. And we can see that now as credit score increases, delinquencies decline, and the annualized gross losses decline. It's a relatively strong signal that applies to both PosiGen and the non-PosiGen programs. We can still see some of those programmatic differences with the PosiGen delinquency rates in yellow generally being a little bit higher, but their annualized gross losses are also a little bit higher as well. We're going to unpack that, but the main takeaway here is just that credit score is strongly related to performance in both programs, with higher credit scores leading to improved performance. So next, we take a look at performance by area median income, or AMI band. And unlike, or sort of in contrast to the credit score, we don't see as strong a relationship between AMI and performance for either PosiGen or the non-PosiGen program. Still, we can see that the PosiGen losses are generally a little bit higher across the income bands, and that PosiGen customers are also more likely to be delinquent than non-PosiGen customers in bins below 100% AMI. Overall, though, there still isn't as strong a relationship here as we saw with credit score. So now we're going to take a look at how performance changes over time for the different PosiGen loan vintages. And by vintage, I mean loans that originated in the same year. So 2016 captures loans that were issued in PosiGen from January all the way through December. And we're measuring the cumulative gross loss been in each of those years. So what we notice is that in each of these vintages, after the second year, there's a little bit of an uptick in the gross losses, but that they're also comparable over time, where we don't have the full time series out into the future to see where, say, the 2017 and 2018 vintages will go, but we're seeing that they're at least beginning similar to the 2016 one, which indicates some consistency over time. For that oldest vintage, 2016, where we have sort of 4 years that we can look at, the cumulative gross loss rate reaches 3.5 years after 3 years of season. Now we're going to take a look at how performance varies by system size. We don't really find much of a relationship between system size and performance, either in terms of delinquency or gross losses. We do, however, still see some of the programmatic differences with the PosiGen delinquency and losses higher than the other programs for the small and medium-sized systems, less than 10 kilowatts. This figure also makes clear something Greg mentioned earlier about how PosiGen Finance is sort of a standard set, where the size of their systems are somewhat standardized. And we can see that in the concentration. I think that more than 80% of the systems coming in between 5 and 10 kilowatts, and very few large systems beyond 10 kilowatts in the PosiGen program. So I'm going to get into our regression analysis, which helps us sort of unpack the high-level figures that we were looking at. And there are important differences between the programs and the customer characteristics that are difficult to tease apart with just looking at a couple of figures. So this analysis is intended to explain the differences in performance that we've observed so far between PosiGen and the other CGB products. Really want to be able to estimate how various factors impact the likelihood of delinquency and early terminations in these programs. So in addition to some of the important customer characteristics we've discussed already, such as credit score and income in the form of area median income, we also considered the lease or loan seasoning, how long one of them has been around, the principal amount, and the programs themselves. So I'm going to walk through some of the results that we found, and then we're going to interpret them a little bit. So first, we find that the principal amounts and the census tract income are not statistically significant predictors of delinquency and early termination. And that's consistent with the figure that we were looking at earlier, where there wasn't that strong relationship between AMI and income. When we look at seasoning, or how long the loan has been around, we find that it is a statistically significant predictor of early termination, but not delinquencies. That means that the longer a loan has been around, the more likely they are to have been terminated early. And that makes sense. The longer that a lease or loan exists, the more time there is for some event to occur that can affect the ability to repay. So when we look at credit score, we unsurprisingly, I think, find that it is a statistically significant predictor of delinquency and early termination. And that's completely in line with the figure we were looking at earlier, where as credit scores increase, there is a decreased chance or lower rates of delinquency and annualized loss. So we're finding that the lower credit score customers are more likely to be delinquent and more likely to have been terminated early. So to illustrate the importance of credit score, use this example of what is the impact of, if you take the average PosiGen customer, their credit score, and the average credit score in the non-PosiGen program, what is the impact of that difference in credit score? So that difference is 117 points, and that translates to a 2.3% increase in the 30-day delinquency rates, which more than explains the difference in delinquency rates between the two programs. So just by moving the average credit score from the PosiGen level to the non-PosiGen level, that equates to an impact in terms of the increased delinquency rates more than that we see between the programs themselves, which just indicates that credit is a really strong and important part of explaining the difference that we observe between these two programs' performances. That 117-point credit score difference also translates to a 0.8% increased chance of early termination. Let's take a look at the impact of the programs themselves on performance, accounting for all their factors. So that's when we sort of hold credit score, income, seasoning, all those other things constant. We're able to look at the impact of what it means for a lease or loan to have been originated within a particular program. What we find is that PosiGen leases are slightly less likely, 1.7%, to be 30 days or more delinquent compared to the other CGB loans and leases. When we look at longer-term delinquencies, such as 60-day or 120-day, we don't find a significant impact from the program stats. So yeah, the impact is more on these shorter-term delinquencies. We also find that the PosiGen leases are 2.6% more likely to be terminated early relative to other CGB leases and loans. And again, these are the program impacts when important factors like credit score and seasoning have all been controlled and accounted for. So just to sort of walk through again some of the important takeaways, what is the consequence of these regression results? And first we conclude that the differences in performance between PosiGen leases and the other CGB leases and loans is largely due to differences in customer credit. Second, seasoning affects early termination rates, but does not explain programmatic differences. Third, we find that relative to other CGB programs, given customer characteristics, PosiGen customers are less likely to have short-term delinquencies and not have longer-term delinquency. Fourth, we find that PosiGen does experience more early terminations than we would expect given the credit score and other factors. It's also, I think, worth noting that not all terminations result from delinquency, which suggests that there are factors other than payment performance that might explain the higher likelihood of early terminations among PosiGen customers. So as mentioned earlier, there's some redeployment of PD systems that could occur within PosiGen. Right now in their Louisiana program, which has been around since 2012, PosiGen has been very consistent in redeploying the systems from early terminations. Upwards of more than 80% of these early terminated lease systems associated with leases that have been terminated early, about 80% of them have been redeployed. This is a pretty high share compared to other solar financing programs. Right now, no PosiGen systems have been redeployed in Connecticut, but as we mentioned, they are implementing these standard system sizes that could facilitate redeployment. If PosiGen is able to achieve these levels of redeployment rates in the Connecticut program, this could really mitigate the losses that we've been observing, that we observed in the PosiGen program. I just want to summarize again some of the main takeaways here. Without taking important factors like credit score into account, PosiGen has higher rates of delinquency and loss compared to the other CGB products. But once we take things like credit score into account, we find that PosiGen is less likely to have short-term delinquencies and more likely to have early terminations. Census-tract area median income is not a statistically significant predictor of delinquency or early termination. Redeployment at scale could significantly reduce PosiGen's loss rates. And finally, everything that we've covered so far is PosiGen relative to other CGB programs. The CGB programs might be distinct relative to other solar financing programs, So in the next section, we're going to expand this comparison to include other solar loans and consumer lending, give a broader sense of how PosiGen relates to similar financing products. And with that, I'll turn things over to Jeff.
Thanks, Sean. So Sean already gave me my intro here, which is we have been really zoomed in Sean's section to these questions of how the PosiGen programs performs compared to other Connecticut Green Bank products. And this was an important analysis, and we had very good data to support this analysis. We had loan level data from all of the programs that we considered. We are now zooming out considerably, and we're going to compare the PosiGen program's performance to essentially three different external benchmarks. One is what we call market rate solar leases and loans that are outside of Connecticut. A second is auto loans, and a third is consumer loans. And so we're progressively getting into essentially broader pools of loans that are less perfect comparators with the CGB PosiGen portfolio. But at the same time, we feel this is an important comparison to sort of fully contextualize what kind of performance we're seeing here. Not a lot of people might know exactly how Connecticut Green Bank solar loans perform, but if we can compare this performance to much larger sets of auto and consumer lending, this really helps to contextualize what we're seeing. So again, we are deliberately zooming out here to somewhat less perfect comparators, but to try to tell the full story here. Whoops. All right. So, and I've already essentially delivered this slide, but again, something of our purpose here is to understand whether the portfolio's performance is sort of within the range of quote unquote normal consumer lender performance. It's unclear exactly what normal consumer lending performance is anyway, so we're going to show you several different things to try to illustrate this. So the first set of comparators that we're going to provide here are from market rate solar products. And so the performance here that we're comparing the PosiGen and also to some extent the Connecticut Green Bank non-PosiGen loan and lease performance to, these are drawn from basically securitization documents filed to document and support the transactions involving pools of solar lease and loan, mostly solar loans that were securitized by some of the folks that you see down here in the legend. These are some of the larger players in the solar loan securitization business: Dividend, Mill City, Mosaic, etc. And so what we're showing here on this graph is, on the left side, the y-axis is the percent of the outstanding balance being delinquent. And this is delinquent meaning between 30 and 120 days delinquent. And the seasoning is on the x-axis. So this is showing, the age of the portfolio that is being rendered here on the graph. And it turns out that for delinquency, the age of the portfolio isn't mattering a great deal, but it'll matter more in the next figure. And so we see these PosiGen dots on this chart are the gold ones. And so we see here that the PosiGen delinquency rates are generally at the high end of the range of market rate solar delinquencies. Again, this is not a surprise. We have shown you, and we have discussed a couple of times, the fact that the population that shows up for these PosiGen products is pretty substantially different from those that show up for the other programs in Connecticut, for example. And to the extent that we were able to glean it, we also believe that it is quite different from the people who are showing up, who are reflected in these market rate securitizations as well. And all the securities for which we had credit scores, not all of the securitizations reported credit scores, but many of them do. And all of them that did had credit scores well over 700, which are much more similar to the non-PosiGen Connecticut Green Bank customers than to the PosiGen Connecticut Green Bank customers. And so the next slide is on losses on cumulative losses across the same set of portfolios. So again, we have cumulative loss on the y-axis and the seasoning on the x-axis. Here you can see that seasoning makes a lot more sense. Again, as Sean mentioned, the further you go, the more of a chance there is you can't come back from being a loss. So understandably, the cumulative losses rise over time. And here, we see, again, PosiGen in the gold dots. maybe sitting a little bit on the high end, but really the performance of PosiGen from a loss perspective seems to be not greatly dissimilar from these market rate products, which again, we think have considerably higher credit borrowers in general. The other thing I want to emphasize from this slide is that the non-PosiGen losses reflected by the gray dots here are actually quite low relative to these other sort of market rate securitized loans and leases. And so we've been comparing, and Sean went in great depth to compare the performance of PosiGen with the performance of the other Connecticut Green Bank portfolios, and was showing that in certain cases, PosiGen's losses were higher. Now, this slide suggests that maybe it's the non-PosiGen Connecticut Green Bank programs that have the unusual performance here, and that they are performing considerably better than most of the market, and the PosiGen performance seems more in line with the rest of the market. Okay, now we're going to move to auto loans. So again, a less perfect comparator. There are some things that are pretty different about auto loans and solar loans, and in part, auto loans are secured against the vehicle. They tend to be shorter term, but nonetheless, what we're going to focus on our auto loan comparison is basically contrasting the performance of prime and non-prime borrowers within the auto loan sphere and then within the PosiGen program. And so what we're seeing here, and we have, again, the share, and the y-axis is the share of delinquency or of loss in each of these portfolios. And the left two bars are auto loans drawn from an auto loan index maintained by the Kroll Bond Ratings Agency. And we see that the non-prime, both delinquency and loss rates, are much, much higher than the prime delinquency and loss rates. And this is not a surprise for any of you who may have looked at this kind of data before. Again, you tend to see significantly higher losses in the sort of lower credit sphere borrowers than you do in higher credit borrowers. It's a big difference. And over here in PosiGen, you can see there is also a difference. So here we are splitting the PosiGen customers into prime and non-prime categories. We use the credit score cutoff of 640 for this particular split. There's no hard and fast credit score cutoff for what prime and non-prime mean. And so here again, among PosiGen customers, you see that the non-prime customers certainly have higher delinquency and loss rates than do the customers we might consider to be prime, but the difference is not as great as it is in the auto loans, right? So if you take the share of the non-prime delinquency and loss rates to the prime delinquency and loss rates, those ratios are smaller for PosiGen. So in other words, the contrast between prime and non-prime borrowers is less significant for PosiGen than it is for auto loans. And this suggests that the PosiGen program is delivering performance from the non-prime customers it serves that is at least in line with, or perhaps better than, what we might expect, and that the structure of the program is allowing, sort of stronger relative performance from its non-prime participants than we might have expected otherwise. Okay, and finally, we're going to do a couple more comparisons of PosiGen with a broad set, the PosiGen leases and the other Connecticut Connecticut Green Bank solar products with a broad range of consumer and auto loan pools. I'm not going to go through in exhaustive detail what all of these different pools are. There are a number of notes here on the right-hand side of the slide. But the takeaway here is the PosiGen lease performance in terms of its 30-day delinquency rate. The pool sits right kind of in the meat of this distribution. Similar performance to what we call tier 1 consumer loans, which are fairly high credit loans, or from KBRA, or similar to all consumer loans, including credit cards maintained by the Fed. Certainly quite a bit better than the non-prime auto loans, which we already showed you, as well as quite a bit better than the tier 3 consumer loans maintained by KBRA, which have credit scores that are in a similar range to PosiGen. And we also put the other Connecticut Green Bank products on this graph, again, to highlight the fact that those products are performing very, very well. And so, again, reflecting back to the comparisons that Sean made, we were comparing the PosiGen leases to products that are performing very well relative to their market benchmarks in that section. And this next graphic is the same graphic, but for annualized loss rates. And you see a similar story. In fact, maybe the PosiGen leases actually edge even a little bit further leftward. So again, the loss rates that we see in the PosiGen portfolio are, well within the range of some of these other, other loan products that have large and sort of self-sustaining consumer markets. And the other Connecticut Green Bank solar products, again, have very, very low loss rates, showing exactly what we were comparing to earlier in the deck. So our takeaways from this, again, first and most importantly, there's no perfect external comparator here. All the comparisons have their challenges. There are a number of reasons that auto loans or consumer loans are not directly comparable to solar loans. We couldn't take all of that into account. We didn't have loan level data on those products. But the point of this is to show that PosiGen delinquencies, so again, relative to the solar rate products, delinquencies look a little high, losses look essentially comparable. And given that those comparators are all market rate products that are not primarily targeting LMI customers and or credit challenge customers, we feel like the relative performance of PosiGen is pretty strong, given that comparison. And we also show, with the auto loan comparison, that we feel like the lower credit PosiGen customers relative to the higher credit customers are performing pretty well, in line with their better than expectations. And then again, the performance of these leases as a portfolio is competitive with these broad aggregates of consumer and auto financing products that have been marching along in their own markets for some time. And so a very quick overall perspective, and then we're going to switch to Q&A here. I'm going to actually move on to this slide, which is that the PosiGen program seems, from Greg's section, to have been somewhat uniquely successful among the Green Bank programs at deploying solar PV in LMI and credit challenged households in Connecticut. We feel on balance, our analysis shows that these customers are repaying their leases at reasonable rates given their credit characteristics. And this also holds when you compare them to similar asset classes. And then finally, the point of this work is to hopefully, inform some efforts in other places to think about programs that might reach this population. And we do need to emphasize that details of program structure can matter a great deal, and they may affect both the terms that these customers would experience, as well as the costs and risks that they would experience. And so, this is hopefully providing a lot of information in this context will be helpful externally, but a whole lot of things can be different as we consider different contexts. And with that, I will close and hand to Nate for some Q&A, I assume.
Great, thanks so much. Thanks for that robust analysis. And yes, indeed, we have lots of questions, and so we'll move promptly into Q&A. And I think I'm just going to take them in the order they came in. The first question: was there any PosiGen offer delay in calling a loan due to COVID issues, so they were not considered delinquent for a different period of time?
Yeah, go ahead, Greg.
Oh, well, I was just going to say our analysis period does not cover it. The data are as of March of 2020, so we just missed any COVID, any analysis of COVID impacts.
Great, thanks. Next question. So the data you had clearly differentiated between census tracts. Were you also able to see how many different municipalities in Connecticut PosiGen installations were included? Do you have a sense of that?
I will let either Jeff, you're on mute.
Thank you. So, and Sean, check me on this. I mean, I believe that our data do cover this. I don't think that we did, but we didn't do any specific analysis to, understand purely geographically where these programs are reaching.
Great, thanks. And this might be a question for Sean. I think you covered this in your part of the presentation. How can PosiGen leases be less likely to be delinquent or short-term delinquent and more likely to be terminated? Can you explain? Can you clarify more about that?
Yeah, and Jeff, please jump in here too, because I think there's a little nuance here. So just to repeat it, there can be ups. I think falling behind on payment may not be the only reason. There may not be some systematic thing, or once you reach a certain point, then it necessarily means things will be early terminated. So there might be, I think, program-specific tendencies to respond to, I think, short-term delinquency in different ways, or tendency to terminate leases. And yeah, Jeff, would you have any other way of characterizing that besides it's sort of a programmatic decision of how to treat things at a certain point?
No, I mean, I think so that is one important point, is that when to terminate a lease is ultimately due to whoever, is on the other side of that lease. And so certainly programs can make different decisions in those regards. Another point that Sean mentioned is that not all terminations are due to delinquency. In fact, something may happen. There's a problem with the structure. There's a fire. There's a death. There are various reasons why termination may occur that have nothing in particular to do with delinquency. So again, we couldn't analyze that in a rigorous sense, but our results, I would say, are consistent with the possibility that for whatever reason you're having more non-delinquency related terminations in PosiGen than in some of the other programs. But we can't observe that directly. But I think there are multiple reasons why the path from sort of an early delinquency to an actual termination can be very different in different households, and moreover, why sometimes the path to termination doesn't involve delinquency at all.
Well, by happenstance, the next question might be a good follow-up. On PosiGen's loans that were terminated early, were any of those by persons that just wanted to pay off the loan and eliminate interest charges?
We treated people who paid their loans off separately. There was a whole separate way of sort of identifying them as having paid off. So when we were doing the calculations of charge off, it would have been, I think those are independent of those. If people have paid them off, they're not being charged off. Those loans have been paid. If I understand your question correctly.
Yeah. So when we're discussing early termination, and frankly, it's possible that's not terribly clear from what we've written, but that would not include someone who voluntarily paid it off to avoid an interest charge. That's not included in our early terminations.
Great. And you mentioned the potential of redeploying solar systems to mitigate losses. Do you have any thoughts, or have you heard from program administrators on why Louisiana has been redeploying solar systems since 2012 and Connecticut hasn't done this yet?
I don't know if the top.
I think, honestly,
Jeff, you want to take that one?
I was just going to say, I think, well, I mean, one immediate explanation first of all, this question would be better directed to PosiGen, who is administering these programs and is doing this. The immediate explanation to me is simply that the PosiGen program is newer, and so perhaps they just haven't kind of gotten this pipeline moving yet. But I really think that's best directed to them.
Great, and this may fit in that category too, but the question has to do with the interplay between sort of a cash flow positive guarantee from the customer's perspective and termination and potential defaults. Do you have any comments on sort of the interplay between any kind of cash flow guarantee from the customer's perspective and how that plays out in this analysis?
I'll start. One thing I would offer, so we can't compare. All the PosiGen customers get that guarantee, right? So we can't compare some that have it with some that don't to see directly what difference it might make. One of the things that Sean mentioned, and that one of the graphs in his section showed, is that you actually have relatively few terminations in year one, and then you see somewhat more terminations in year two, that the guarantee could be an explanation for that, where, why would you close up early in year one when you can't wind up, with a loss related to this, or your costs are going down on net. So then again, we don't expect that year two costs would be very different than year one costs, but I mean, that could be a driver of why you don't see much early termination in year one. That's one thought I have. Again, I don't think we can make any credible statements about exactly what difference the guarantee makes, given that everyone got it and we don't have a comparator to kind of difference that effect out on.
Thank you. And I think we'll probably just have time for just a couple more, but we got some great questions. This next one, I wonder if you also have access to data regarding utility savings impacts to customers for both separately the energy efficiency measures per dollar invested and solar PV per dollar invested. Is there an opportunity to sort of analyze and present on those differences?
So it's, in other words, whether the solar PV systems or the efficiency systems would be expected to have larger bill impacts. Is that I'm taking that's the premise of the question. I'm trying to recall. So we didn't. We might have a little bit of information on that in the data. If so, it was estimated before the fact. So we don't have sort of any after the fact information on exactly what utility bills were. I think it's fair to say that we broadly would expect the solar measures to be more consequential to the customer bills than the efficiency measures, but we really didn't. That wasn't what we were studying here, right? I mean, our research questions were about how do the leases themselves perform. So we didn't really look into that.
Very good. Well, I think we're getting close to the end of our hour here. So I'll just ask one more question, then I'll turn it back over to Greg for any sort of concluding remarks. Last question is, most consumer and auto loans may have 3 to 5 year tenures, while solar may have 20 years. Given the increasing likelihood of PosiGen early termination as leases season, what plans are there to continue tracking the termination rates as these leases get into longer holding periods?
That's a great question. In terms of the plans to track them, I can't necessarily speak directly to that. But if there's a way for us to be involved in that, we're certainly interested to do so. It is a very good point that seasoning is a big deal here, and this is a relatively young portfolio. It is fairly common to see, and we see in a lot of other similar sort of loan data on products like this, that losses tend to be highest early on and flatten out a fair bit after that. And so now we can't be certain that will or at least the rate of additional losses tends to flatten out. The rate of incremental loss tends to flatten out. And so that may be less of an issue than we might imagine. And again, we're annualizing all these losses, so we're already accounting for that in some relatively rough fashion. But absolutely, we would not feel comfortable extrapolating off the end of this data set and saying exactly what losses are going to be like, in 10 years. And so someone should track that.
Great. Well, that's terrific, and I apologize for not getting to all the questions. There's some other great questions in the queue, but we are at the end of our hour. So I once again just want to thank you, Greg, Sean, Jeff. I want to thank you for the analysis, which is terrific, and also its contribution to our Scaling Up Solar for Under-Resourced Communities project. Before we close out, Greg, do you have any last sort of parting shots?
Well, I would just say thanks again to you all at CESA and to DOE and especially to PosiGen Community, the Connecticut Green Bank, and Inclusive Prosperity Capital. We really appreciate the chance, and given that there were a bunch of questions, please feel free to contact any or all of us with questions. And yeah, thanks again.
Great. All right. Thanks all. I'm going to turn it back to Samantha to tell us about some upcoming webinars.
Thank you, Nate. So on your screen now, you should see the titles and dates of 2 webinars that we have coming up. One of those webinars is this Friday. The topic is storage as wires, and we're going to have guest speakers from Customized Energy Solutions and the Massachusetts Clean Energy Center on the line for that webinar to talk about storage as wires, solutions, and successful deployments. And then in June, we've got a webinar coming up on community resilience hubs. That should also be very interesting. So you can read more about those webinars and register at CESA.org/webinars. Thank you all for coming today, and we hope to see you at the next webinar. Bye, everyone.